Hello, clients and followers of Provident. Thank you so much for being with us. My name is Chye Hsern and I'm a client advisor with Provident. So the initial plan was for us to have a market review for the first quarter of 2025. However, in view of the recent huge volatility in the markets, we have decided to really focus on what are tariffs, and how tariffs will actually affect our investments currently and in the long run. So my colleague Chye Hsern, Head of Investment with Provident, will be taking us through that. After Chye Hsern's segment, I will be going through with all of you what are some of the considerations that we should have in place before we even start investing so that in the long run, we can reach our goal in a comfortable and reliable manner.
So, first of all, I'm going to talk a little bit about what are tariffs and why tariffs are something that has concerned the world, especially the way the US administration has implemented them. And I think, we have heard a lot about how the world is changing and how this is the biggest impact to the global not the financial system, the global trading system that we've seen in the last 80 years. And I think it's encapsulated in this chart that I'm going to show right now. So these are the highest tariffs that we have seen since the Smoot-Hawley Act and during the Great Depression era in the 1930s. If you were to look at this chart over here, if you look at it describes tariffs from the 1800s all the way to where we are right now. And this is, of course, as of the tariffs that were announced on April the 2nd, right? So all the reciprocal tariffs. It doesn't include further escalations and, of course, de-escalations. But this is just to highlight, the impact of these tariffs. Because if you look for most of the last 80 years, where do you see the tariffs at? Since the Depression of the 1930s, tariffs have largely been coming down. After World War II, the US, as the leader of the globalization and of free trade, has actively worked to encourage more trade and more globalization by reducing its own tariffs to encourage trade, all the way, until maybe about 2018, where they reenacted some tariffs on China, and then, of course, April 2nd. So you can see that this is even higher than the peak of the Great Depression tariffs. And I guess that's why, the impact of this announcement on April 2nd was so large, and that caused a lot of, not just investors, of course, business owners, and many people around the world to be very concerned because they feel that the trading system that we are in is about to undergo very big change. So next, I'd like to just really run through a little bit about what tariffs are, just for some clarity. And I think, first of all, tariffs are a tax on importers, right? Tariffs are something that you put on goods when you import them to a country. So in the case of the US, they are a tax to be paid by the company that's importing the goods to the US. So when it reaches the US port, if you're going to import a good, if there's a tariff on the good, then the company importing the good will have to fill out some forms and pay the tariff, right? So what happens is that they increase the price of exports into the US. So ultimately, who bears the increased cost of the goods? Is it going to be the consumer? Is it going to be the company that imports the goods? Or is it going to be the company that's exporting the good from the other countries? And I think what we can do is to take a look at a scenario of an importer and to just try and understand how this can impact the cost of goods and ultimately companies' share prices. All right, so if we take a look at this table, right, this is a hypothetical scenario of a company that imports shoes into the US. Right? They make shoes, they have factories in China, they have factories in Vietnam, and they have factories in Indonesia. And they make shoes and they import them into the US to sell. So first of all, let's look at this table here, this line here, this column here, right? Cost without tariffs, right? So if we assume it cost them $50 in all 3 factories to make the shoes, right? This is their cost price. $50 to make them and to ship them into the US. And then they sell them for $90. So simple math, what's the profit, right? If you take 90 minus 50, you get $40. So the company makes $40 from every shoe that they sell. That's great, right? That's a very high margin, by the way, but this is a hypothetical scenario. So things are looking very rosy. But what happens when you add tariffs into the equation? Right, so, okay, this is an older number for China, I think 76%, that was sort of being thrown around sometime earlier in April. But I think now it's much higher than that. Then we have 46% for Vietnam and 32% for Indonesia. So these are roughly the reciprocal tariff levels that were announced on April the 2nd. Right, so if your cost is $50, when you import it right, into the US, you're going to write there, okay, the cost is $50. And then if there are tariffs, they'll say, okay, what is the tariff rate on this? So the tariff rate on shoes, if it's from China, it'll be 76%, and Vietnam 46%, and Indonesia 32% respectively. So what that means is, in dollar terms, right, your $50 shoe is going to have a tariff cost of $38. Right? And in Vietnam, it will be $23. And if it came from Indonesia, it would be $16. So what happens then to the cost of importing the shoe? Cost, if you import it from China, becomes $88. The cost from Vietnam would be $73, and the cost from Indonesia is $66. Right? So if you keep your original price of $90, what happens to your profits? Right? From $40, your profit drops to $2 if it came from China, 17 from Vietnam, 24 from Indonesia. And you look at the percentage drop in profit. It's 95% drop here, 58% and 40%. So that is a substantial impact to any company's bottom line, right? All of a sudden, you're paying a lot more for the cost of your goods. So that will impact everything from your marketing costs, etc. So how can companies react, right? What are some possible outcomes from this scenario for the company? First of all, they're likely to raise prices of the shoes to maintain their profit margin, right? But so what's the outcome of that? If you raise prices as a business, what's going to happen? Your goods get more expensive. If your goods get more expensive, will the same number of people be able to buy your goods? Not necessarily. You're likely to see a fall in revenue because less people will buy. And if you're not able, if too many people stop buying your shoes, you're going to see a fall in your profit also, because naturally you'll make less profit if less people buy your goods. So that's one possible outcome. And another one is you ask the supplier to cut the prices, right? You tell your supplier, hey, I've got to pay more, but if I cannot survive, if I can't pass this cost on to my consumers, I'm going to go out of business. You're going to go out of business too, because you depend on me to order goods from your factory, shoes from your factory. So let's cut a deal. Let's work together. You cut your prices a bit. I raise my prices a bit. We can all go home happy and we can all survive. But I mean, that might work for a while. Or the supplier too also has their own margin to meet, right? The supplier might be, okay, maybe if it's a smaller amount I can, but when the tariffs are too high, they are forced to cut their prices too much to the importer. They'll be like, look, I can't survive either. I have to pay my workers, I've got to pay electricity, I've got to pay for the cost of all the materials. If I go out of business, you're going to put me out of business if my cost is too low, if my selling price is too low. So either way, right, it's going to also result in probably a lower supply of shoes. The supplier is either going to make a lot less because prices are going up. Also, if they go out of business, if they're unable to carry on, then the company that's importing the shoes for sale into the US is also going to have a shortage of shoes. So they're also going to lose revenue and profit. And lastly, of course, they can try to keep prices the same, but then that means they will suffer a hit to their profits. And in reality, I mean, there's a mix of all three happening, right now across the world, right? As various businesses that either sell to the US or businesses in the US that are trying to bring in their goods. They are contemplating all three types of scenarios and probably many more, but this is just a simple scenario that I'm highlighting. So they are contemplating all these difficult decisions, right? And they are making choices on, can I keep going? If I keep going, how much should I import? How much should I buy? What's the estimate to my bottom line, etc., etc. So it's a very challenging situation, and so you can see that there's likely to be an impact on companies' earnings, right, on profits. And lower profits means that investors in the company will have to reprice the worth of the company, because before the tariff announcement, I mean, investors were pricing in a certain level of profitability for many companies. But after the tariff announcement, investors are going to expect that every company is either going to have to raise prices or take lower margins or sell less goods and lower revenue, etc. So very rationally, the market has immediately started to reprice, right? And so they sell the shares in the stock market, right? If they think that the value of the company should be lower. And that's what's been happening across the world, at least all the way until April the 9th, when the sort of reprieve was announced. Investors were really trying to reprice and understand what's happening in the market, what's happening to their company's bottom lines, and then repricing the equity values. Right? So as an example, I mean, one of the largest importers from China, Apple, right? They lost 23% of the company value from April 2nd to the 8th of April, right? Because their imports would have been hit with extremely high tariffs. Of course, right now, we have seen that some of these reciprocal tariffs have been rolled back, and in the case of Apple's smartphones, some of that has also been exempted for a short while. We don't know what's going to happen in the future, but for now, the market's also pricing in this information. I mean, Apple stock has rebounded somewhat. It sort of reclaimed the 3 trillion market cap valuation. So you can see that the market is still functioning, right? The market is really working, because it wasn't like, oh, a panic of, oh, people are just selling stocks because of one announcement. I mean, investors were repricing what companies were worth, because it's very evident that if the tariffs stayed, companies would be making less money. And if they make less money, then their shares are not going to be worth what they were worth a couple of weeks ago. And that's why investors were quickly trying to reprice, company share prices. Next, I'd just like to run through how the markets have performed all the way at least up to April the 10th, which is when I was able to pull this data. Right, so it includes the period where the market fell sharply, but it also includes the bounce after the reprieve on most of the reciprocal tariffs were announced. And so what you will be seeing is a chart that shows January the 1st to April the 10th performance of some of the indexes, some of the funds, some of the portfolios that we have, and then also April 1st to April 10th performance, just so you can know the huge impact that the tariff announcements had across financial assets. So if you look at this chart, this shows market index performance, right? So the first one on the extreme left is the MSCI All Country World. So that's developed market stocks and emerging market stocks together in one index. The second chart from the left is MSCI World, so that's only developed market stocks. Third one is emerging market stocks, MSCI EM. The fourth one is US stocks, represented by S&P 500, and the last one is fixed income, Bloomberg Global Bonds. So, and of all the returns are in US dollars, just in case you can't see the terminology, it's in US dollars. So if you look at what happened, MSCI All Country World, right, emerging market stocks and developed world stocks together, it fell about 7%. Starting for the year to date, 10th of April. But in April alone, this green chart, this green bar here, month to date, 1st April to April 10th, it fell 5.8%. So it's been a pretty big drop in equities. But if you look at the developed world stocks and emerging market stocks separately, you can see that MSCI World developed world stocks fell 5.7% in the month of April. And emerging market stocks actually fell more, 6.4%. However, for the year, emerging market stocks have actually been doing better than developed world stocks. It's only down about 4.8%, while developed world stocks is down 7.6%. So you can see that in this instance, overall emerging markets are still doing a little better than developed markets, but the impact of tariffs was definitely felt in emerging market stocks greater because they fell more. Right? But the S&P 500, you can see that overall developed world stocks fell about 5.74%, right, in April, and that includes stocks from Europe, Singapore, Japan, Australia, etc., all the developed world countries, and of course the US. But US stocks alone, S&P 500 fell about 6% for the month of April to April 10th. So you can see that disproportionately, US stocks definitely have been hit harder by the tariff announcements, because a lot of the impact of tariffs will be felt by US companies because they have manufactured a lot of goods outside the United States, and they have to import it to sell to the US market. Overall, you can see that S&P 500 has fallen about 10% year-to-date April 10th. So definitely one of the weaker performers in the year so far. But fixed income, right? We have always mentioned that fixed income is a stabilizer in our portfolio, and despite all the noise about US yields going up, fixed income fell about only less than 0.5%, 0.4% in April. And for the year, fixed income is still up at 0.77%. This is a diversified basket of global bonds. So it's got US treasuries in it, US bonds, but it also has Japanese bonds, which went up during this period. It has European bonds, German bonds, which went up during this period. And this index also has Chinese government bonds, which also went up during this period. So as you can see, being diversified helps protect your portfolio, and fixed income, even if it falls a bit, I mean, it's nowhere near the volatility of stocks. So the first time tariffs went up a lot and very high, right, was the Great Depression. I mentioned that earlier. So if you look, tariffs went up at about 1930. And so if you see, this is a chart from 1928 all the way to 1945 after the Second World War. You can see that, yes, of the S&P 500 index. So you can see that when tariffs went up, that was close to when the market was at a high at the time. Right, so if you invested $1, then it actually went up 91%. Before the tariffs, you would have made 91%. But after that, it fell quite substantially, about 80%, right, as the tariffs happened, and it exacerbated the Great Depression. There was a lot of economic pain, and so stock market fell quite badly. But after that, over time, it actually did recover, largely quite close to back to where it was. Then I think World War II happened, and so that added a lot more uncertainty. Market fell again, and then eventually it did recover in the future. So sharing this because times are definitely uncertain now, and of course we are hoping that this doesn't happen. Right? As it stands right now, markets have recovered. Right? The tariffs have, a lot of the tariffs have been rolled back, so it's not the same scenario. Right? But just sharing like the impact, the possible impact, and just to be prepared, that it's not necessarily a situation where the market's going to bounce immediately, and it can take some time to recover. However, we don't know the future, so we definitely should just keep in mind that there are some possible scenarios, worst case scenarios that can happen, but we should also not immediately think that the worst is going to happen, because it's definitely not the same. Another time tariffs went up was actually in about 1970, 1971, when the US moved off the gold standard and devalued the currency. They increased tariffs only about 10% that time. It was 10% blanket across all goods for a while. And so you can see that the market fell a bit, and then it didn't do much for quite a while, right? For about 10 years, right? The market, well, if you invested in 1968 all the way until 1978, maybe it was up only about 30%. And this was during the stagflation period and period of high inflation. So yes, despite the inflation, despite the tariffs for a while, the market did go up a bit, right? After it fell, actually it did recover quite a bit to actually a newer high. So it's not like the market can't go up during even times of economic uncertainty, even when there are some tariffs or even when there's inflation or stagflation. But it can go up, it'll come down again. But I think overall, you can see that after the US figured it out, they managed to beat the inflation, the market started to rally even more strongly. And sort of that's been the period that we've been experiencing since 1980, where, of course, for quite a prolonged period, the market has been going up. Despite various recessions, yes, the market's come down, it also has recovered again. But this is just to give you an idea of the last 2 times we have seen tariff levels that are higher than what we've experienced prior to April 2nd. And I think I'm going to round up by just sharing a few, thoughts and also just some data on the markets, how markets behave after they fall, and also some time frames on how long it takes for markets to recover. So, if you look at this chart here, it just shows that, the time periods that the markets have declined, right? The US market has declined, how many days it takes for the market to reach the bottom, and how many days it takes to recover. So of course, Great Depression is right at the top, right? One of the largest declines. And of course, it took a long time, 800 days for the market to sort of reach the bottom, and 3,700 days for the market to recover. But that is quite a big outlier, right? And that was a time period where they didn't remove the tariffs, right? So we're not there yet, or we're not there, we're not nowhere near there yet. So as you can see, most of the other periods, right, even the period of stagflation, like 1973, the market fell about 48%, right? It recovered in about 576 days. That's about 2 years' time, right? So just wanted to share this because it's true. Out of the last 16 bear markets, right, most of the time the recovery was actually within a year. But this time around, we are just trying to be more cautious by saying, well, it will recover, but let's not get carried away and expect that it's going to recover within a year, right, as the last few times that we have experienced market drawdowns. So, but yet, despite that, all that data that we see, right, the market does recover, right? The market does actually give you higher returns. If you look at, this is all the way back to 1926, which means that this includes the Great Depression period, this includes the stagflation period, right? If the market falls more than 10%, right, 1 year after that, there's a high probability that it's up 11.7%, right? 3 years after that, it's probably up 10% annualized, and 5 years after that, it's 9.6%. So what that means is that the markets can fall, and even through periods like the Great Depression, even through periods like the stagflation where they didn't do all that much, the probability is that 5 years on, you're likely to have a positive return. So that is a very key thing to take away, because even though there's a lot of uncertainty right now, you want to make sure that you invest with the right mindset in mind. So last couple of slides, this one just shows, this one just shows that if you invest and you miss some of the best days, right? Because a lot of the instinctive reaction is to say, okay, well, it's going to be bad, right? Maybe there's going to Great Depression is going to happen, market's going to fall a lot, or GFC or something like that is going to fall another 20%. I should sell now and then buy back later. I think that's something that is going to be on the mind of everybody, right? If I can time it perfectly, I'm going to do very well. That's true if you can time it perfectly. But a lot of times, if you miss the days that the market rebounds, like if you miss the rebound that happened on April the 10th, right, when the reprice was announced, or April the 9th when the reprice was announced, you miss the rebound, it's going to affect your performance, right? Because that's one of the best days. That's one of the best days in recent memory. Right? And what happens if you miss one of the best days? Right? If you invested $1,000, right, over 1990 to 2024, right, you would have made, it would have become $34,000. But if you miss the best day, it would be only $30,000. So you can see the impact, right? The difference of missing just one day is $4,000 out of your $1,000 investment. If you miss 5 of the best days, you only get $21,000. So this is so important, right? And if you think about it, would you have been able to catch the best day recently? I think most of us didn't catch it because everybody was expecting the market to go down more. Right? So if you had sold out and you didn't buy back in time, and which is very unlikely that most people would have bought back in time, you wouldn't have been able to, you would have significantly impacted your performance. Like this is just to highlight. And the best days are usually very close to the worst days. So like if April 3rd and 4th, right, the market fell 10.5%. And April 9th, it went up 9.5%. So you can see that, and that was really one of the best days in a long time. So you can see that if you miss that best day, you significantly impact your performance. So how should we handle this uncertainty? We should, stay calm, right? Despite all the noise, we should stay calm and make our decisions clear-minded and calmly. I think focus on the things that you can control. Yes, there's a lot of uncertainty. So if you are concerned, you can, instead of focusing on how the market will do, which we cannot predict, you can focus on things like your emergency funds. You can focus on the cost, keeping the cost of living down if possible. Or you can also just focus on other things and not read too much of all the negative news. It's important to know what's going on, but don't get too sucked into all the negativity. The world is still functioning, and every day, the world is still spinning around, the sun is still rising. So maybe you can focus on the more positive things. Next is to really have a plan and really understand how it's implemented, right? It's easy to just say, oh, stay invested, but really stay invested in what? With Provident, you have had a plan. You know that if you are on Retire Well, you have a certain amount of cash set aside for you to make sure that your spending needs are covered for the next few years, to give you a chance to ride out the volatility, even if it's 5 years or 10 years. You know that your portfolios are in diversified instruments, right? The US market might have been the worst performer, but it's not all of our portfolio, right? We have 40% of the portfolio equities outside of the US in Europe, in emerging markets in China that have all done better than the US over this year so far, right? Your portfolios also have fixed income if you're in a portfolio with fixed income, and as you saw earlier, the fixed income fell a lot less and helped stabilize the portfolio. So understanding what is in your portfolio will also help you, know why you're investing and what you're investing for. And lastly, don't make a portfolio change just because of the short-term volatility. It's perfectly sensible to make a portfolio change if life circumstance has changed, if your financial situation has changed, if you need the money for whatever reason to fulfill any life goals, for any emergencies, that is a good reason to make a portfolio change. But making one just because the markets fell and you're concerned that it's going to fall more, when you actually have a plan, and you need to invest for the future, that's not the kind of portfolio change that we would encourage you to make. So thank you very much.
Thank you so much, Chye Hsern, for the very insightful session. One of the things that we can get out of this session is that we need to stay invested for the long run. And while we hope that markets do not stay this way for an extended period, there are some considerations that we can take on our side to make sure that our wealth management plan remains robust in uncertain times like this. So what are some of the considerations that we can have in place? The first thing is that we should have sufficient liquidity. It is advised that we set aside an emergency fund of at least 3 to 6 months of our expenses. This is to ensure that, in the event that an emergency occurs, we have sufficient liquidity to meet our needs, and we do not need to touch on our investments at the wrong time. Right? So if let's say we have got short-term needs, for example, anything that is less than 3 years, for example, a planned property purchase, or our children is due for their tertiary education in less than 3 years, it is our belief that we shouldn't be investing all these monies in equities, because equities in the short run can be very volatile. And of course, investment 101, we need to stay invested in the long run in the right instruments for us to get the returns that we need. However, during this period in time when we are staying invested, things can go wrong. So it is important that we have sufficient risk mitigation plans in place so that when a crisis hits us, we do not need to touch our investments at the wrong time. So what are some of the crises that can cause our plans to change? A sudden critical illness, disability, or a premature death of a breadwinner. We need to ensure that we have got sufficient medical plan in place, a robust plan in place, such that our medical needs, our medical expenses can be paid off. And lastly, should a severe disability occur, we need to ensure that we have got sufficient long-term care or a occupational disability plan in place to make up for the loss of income. And of course, we have got various goals and various life aspirations, and all these goals and life aspirations will occur at different point in time. For example, if let's say our children's education is due in 5 years' time, it is not prudent to be invested into a full equity portfolio, right? But if let's say we are only retiring in 25 years' time, that gives us a long runway for markets to correct and to markets to stabilize in the event that markets take a hit. So it is important for us to determine the goal that we are investing for, the time horizon that we have, and from there determine the kind of asset allocation that we should be going into. And lastly, it will be our willingness to take risks, because while we have the need and we have the ability to take risks, our need is based on the need for returns, right? And our ability, as I've stated above, it is like whether or not we have sufficient emergency fund, whether or not we have got sufficient risk mitigation plan. If we have the need and the ability to take risks, but emotionally we are not prepared for the ups and downs of the markets, we may not be able to stay invested and get the returns that we need. So it is also very important to understand psychologically how are we wired and are we actually prepared for the ups and downs of the market. And finally, it is also of paramount importance that we educate ourselves in terms of our financial literacy knowledge. It is important to understand what we are getting into, what are the mechanics behind the various asset classes, and this is to ensure that we develop the sense of discernment and to have the confidence to stay invested when markets actually take a downturn. Okay, so what are some of the things that we can do while we are staying invested during uncertain times like this? The first thing that I think we should really consider or reconsider is if we are thinking of changing our job. We may really want to reevaluate whether this is a wise decision, whether or not the industry that we are going into, will it be affected by the tariffs, or even the stability of the job or the company that we are intending to go into. The second thing is that we really want to delay non-essential purchases, for example, changing our car, or upgrading our property. We can also build additional cash buffer by trimming discretionary expenses or spending. For example, if let's say we have the habit of going on annual family holidays to exotic destinations, we may want to have a holiday at a nearer destination. Or if we are always dining out at expensive restaurants, we may want to cut down on that as well. And because when there is a market downturn, we are actually buying in at a discount. So if let's say we have got surpluses that we are very sure that we are not going to use in the short term, we can consider making periodic pop-ups into our investment portfolios to make use of this opportunity of buying at a lower price. And it is important that we should update our trusted client advisor of any short-term cash flow needs or any significant life changes or situational changes in our financial position, so that the client advisor, your trusted client advisor, can actually make changes to the initial plan, initial report that he or she has written for you. And having regular reviews is something which is very important as well, because it is crucial that we track the progress of our investments in relation to our goals. That's why over at Provident, depending on the complexity of needs, we endeavor to meet up with our clients at least once every 2 years, or whenever it is necessary, to ensure that their plans are going in accordance to what was written. So with that, I hope you have found today's session useful and providing you with the confidence to stay invested in the long run and to ensure that your financial position is sound before you even start investing. Thank you.